And effectively what that is the banks want to be able to borrow an unlimited amount of money from the Fed with which to buy treasuries. And so the banks would be the ones monetizing the debt. So that's
It,
kind of QE infinity. And yeah,
yeah.
it's complicated, but that's what it boils down to, right?
So that's huge.
Yeah,
And
it is huge.
that's huge. So can we work that out a little bit more? So that's banks borrowing directly from the Fed, and I'm assuming they would never have to pay it back.
I think that's right. I think that's right. I mean, what's not clear is what the terms would be, but I'm assuming the Fed will make it on a, on a basis where the banks can make a spread. And so, I mean, what we're kind of dancing around here, as we all know, is that the government's terribly over indebted, and the debt is, the cost of the debt, which is running at 1.1 trillion today, headed to 1.6, is really, helping to blow a hole in the budget. And so, the Fed's got to find ways and means of getting people to buy the debt and make it look like they're not printing money. And, a change in the supplementary leverage ratio would be one way of doing that. So I expect the Fed to continue to, as much as possible behind the scenes, try to keep, the money spigot flowing, but try to hide it as much as possible as well, because they also know that everyone seeing that is going to therefore, uh, anticipate inflation and pay, push the inflation rate up, right? So, um, they're really, the Fed is really horribly trapped. I mean, they can't, with the leverage that exists in the system, they can't stop printing money or else everything will collapse.
Right.
But in turn, as you and I both know, that printing of money is what leads to inflation. And they've got a lot of people complaining about inflation, rightly so. So they've kind of cooked the inflation prints, but they have managed, the prints have come down from, kind of 9 to 3. And my sense is, based on recent comments by Powell, that they're going to kind of declare 3 is good enough for government work. We're going to get to 2. And therefore we are going to do some cuts, because if they don't do the cuts, as I said earlier, that $1.1 trillion interest cost that the federal government is now bearing is projected to go to 1.6 by the end of calendar 2024. So that's another, $500 billion of deficit. I mean, that's the other thing I should point out, that I just think I'm in the process of writing my first quarter letter. And so several things jumped out at me. The biggest one, and these are things that everyone's known, but you got to put them together. In the first quarter, or the fourth quarter of 2023, which is the first fiscal quarter, because the federal government has a September year end, the government ran a $500 billion deficit. So if you annualize that times 4, it's a 2 billion run rate, and it's lumpy, and that may not be right, but it's close. In turn, they also recently, as well as Washington Times had headline that said, in 100 days, the government debt went up by $1 trillion. So U.S. federal government debt grew by $1 trillion in 100 days. Well, there are 365 days in a year. So if that rate were annualized, that would mean the federal debt is growing by $3.65 trillion per year, which is a lot bigger than the $2 trillion deficit, and which would
Yeah.
probably represent a growth of 10% in the federal debt. Whereas in GDP, I think is growing at around 2.6 or 2.8.